Good morning and welcome to the Saxo Bank Morning Call. It is Wednesday, April 10th, 2019, and we have markets that are in a rather happy mood. If we look at our Global Risk Appetite Index, this is an indicator I've developed over the last 2 years. You see that we're actually at the highest levels in the index component since back in 2017. So before that first really ugly sell-off in markets in early 2018, this uses a combination of the outlook for, not the outlook, but measures of corporate credit strength, emerging market credit, and market volatility. I think that market volatility is one of those things that's really dragging the index lower, especially in the FX space. And interesting to see how complacent markets are as we've come back so dramatically from those 2018 lows. Now, one of the things I would suspect at some point has to start impacting risk appetite and the global growth outlook would be crude oil, where we've seen not quite as impressive a comeback, but a very strong comeback in oil prices. Yeah, the comeback continues, and as you can see on the chart here, we're still aiming higher, and the overall reason is well known: lack of tight supply. And this week we've seen the outbreak of unrest in Libya around Tripoli, and that's adding to the risk. But you're absolutely right, John. Last year we were $10 higher from here, and that was really when the market started to take note, and we had some troubling oil price rises, especially in emerging market currencies, which were weakening against the dollar at the same time. Just for today, we got the weekly inventory report, and as you can see in the table there, the API last night came out with quite a decent rise in crude oil stocks, but a continued big drop in products, and we're looking for that to be replicated this afternoon by the EIA survey. But yesterday there was actually quite an interesting phone call from Trump to Saudi Arabia, to the Crown Prince, basically just talk about maintaining market stability, and we know that the waivers against Iran needs to be extended in the beginning of May, and at these current levels, I think Trump will be troubled by cutting production, or forcing a down production, because the prices are rallying as they are. You almost can feel the next Trump tweet coming on when oil prices continue to rise. Now that's West Texas Intermediate, still below 65. The Brent above 70. And Kim Kramer, you sort of picked up on the same pattern, this sort of rising channel here. Yeah, we looked at this last week also, but actually the past couple of weeks, and yeah, it looks a little bit similar to the crude oil. Closing in on the 61.8 retracement. But as Ole said, I mean, we are in a rising channel. I don't see much weakness. Maybe a little bit exhaustion here on the short term. Maybe we should test the 200 moving average from the upside before we take the next move up. I think also what we should mention is that, as you started, John, is basically we had the IMF yesterday out basically downgrading global growth to the lowest in 10 years. So having tight supplies, which is managed by producers at a time, and thereby rising price at a time of worries about the growth, it's not a good cocktail, and again, something's going to give sooner or later. But it does feel to me like the IMF thing is, of course, very significant, but as well, the market narrative seems to be shifting towards hopes that growth outlook may be picking up again with Chinese stimulus, some of the leading Asian economies, hopes that actually maybe the outlook isn't so grim after all. So we'll see. I think it's at interesting levels and an interesting pressure point on a market that is otherwise very complacent. Looking at something like the NASDAQ 100, though, Kim, you're picking up on something that could be a little bit bearish with some divergence, momentum divergence. Yeah, there's a momentum divergence, as we can see here on the chart. It's forming this kind of a rising wedge pattern. As you can see, it's fading a little. I think we are in an exhaustion mode. I know a lot of people will say, no, it looks rosy and good, and we are almost at all-time high levels. But as you can see from the falling blue line I drawn on in the sub panel, which is the RSI, the peaks there are actually falling, which means that the strengths are fading. The strengths are not confirming the past about 10 weeks uptick. So at breakout of this rising trend line, well, we could see potentially a retest of the 200 moving average. However, I do believe that it will not be a massive sell-off or anything. April, I still think, will be fairly positive, but thinking about May usually is a little bit weak. So go away in May? Is that the
sell in May and go away? Maybe. I think it's too early, but sometimes it actually comes earlier than expected, and other times it drags on.
But timing-wise, it's also interesting that we're seeing a pattern like this just ahead of the earnings season, getting into full swing late this week and into next week. So I think maybe a bit more volatility picking up in the equity market, even if, as you say, we're not necessarily expecting a huge collapse or anything. If we look over at the day's event risk, we have an ECB meeting up later today. It is a Wednesday, but we do have an ECB meeting today. And I just wanted to put this chart up of euro-dollar, showing, of course, the long-term frustration and lack of breakouts. This very well-established range between 115 and 112 with a bit of slippage. I put it in the ECB meeting where we saw that very dovish surprise. Tried to break out, couldn't do so. Maybe you were waiting for the FOMC for a signal. Tried to break out to the upside, couldn't do so. And here we are back at square one. I'm not sure the ECB has a lot to say. I think that we need to see for euro upside more surprises on European growth. And maybe also for euro-dollar upside, we need to see some negative surprises for the U.S. And specifically today, that could be more in the form of the CPI release rather than the FOMC minutes. After all, as we just showed you on that chart, that FOMC meeting itself, which is about as dovish a surprise as we could expect, failed to get a significant dollar sell-off going. So the market more aggressively pricing in Trump's new appointees potentially and other, of course, FOMC members moving towards a rate cut more explicitly in their outlook because, for example, CPI is slipping lower. I think is a more credible path to dollar weakness here. So we'll see. Seeing is believing certainly on these euro-dollar breakouts. Now, shifting gears completely, let's look at the grain market. We have some interesting weather conditions out in the U.S., together with some massively bearish supply fundamentals. So really a bit of tension in the outlook versus the current state of stocks.
Absolutely. We have a battle. And just to mention about oil, that the market is looking ahead, saying, well, this is looking at historic data and compared to looking ahead. This is also what's happening right now in the grain market. We had a report out yesterday, the monthly stock report. As you can see on the table here, that it was there was quite a big upgrade to the corn ending stocks, up by 46 million bushels. Wheat was revised high as well. You can see on these charts for the soybeans stocks in the U.S. are way above the averages due to the Chinese-U.S. trade war has left a lot of soybeans in the tanks. Corn is rising rapidly, as you can see as well, and we can see elevated on wheat. But in the right-hand corner, you can see this very, very dark blue dot in the middle of the U.S., and that's really what the market is now focusing on, because even though we had this report yesterday, corn dropped, but it quickly bounced again, because we're having some really troubled weather. We had a lot of flooding, and now it looks like there's a potential risk we could have up towards 2 feet of snow in certain areas, and this is at a time where the machine should be busy in the fields. So as long as this carries on, then farmers may be forced to switch from corn to soybeans, which is planted later, and thereby you should probably keep an eye on the spreads between corn and soybeans, and also the spread between old crop corn and new crop corn. There's some movements going on there, so there's some support starting to come in for the new crop contracts. But obviously these weather conditions, they have to improve fairly soon.
Yeah, there's been a very odd season, unseasonably wet weather across a lot of the western U.S. there. All right, let's, before we get to a couple of points I have on FX, we have just a brief gold chart. I think it's interesting to see. We have the dollar a shade weaker, and we have gold heading away from what looked like, Kim, what you've identified as a head and shoulders pattern.
Well, yeah, it looks like a head and shoulder pattern, but it is not confirmed. As you can see, the neckline, the horizontal line, has not been breached. So we have an uptick after the test of the 1280. So if we don't get a break of the support, well, then it is a busted shoulder pattern if we get an uptick here the next couple of days, and especially if it takes out the so-called right shoulder. So look out for that.
1325 or so, a little bit less than that, around 1325.
Yeah.
Okay. One event that unfolded already this morning was a Norwegian CPI release out quite hot at 2.9% and 2.7% on the core versus 2.5% expected. Those are year-on-year figures. NOK jumping. We're seeing Euro NOK finally starting to confirm that sort of test below the 965 area and that 200-day moving average, which is the blue line you're seeing there. So setting in motion what was a very supportive backdrop anyway, with strong risk appetite, strong oil prices. If these conditions continue, certainly seeing plenty of support for a move towards the lower reaches of that range towards 940. So keep an eye out on NOK crosses. as well with the Swiss franc weakening a bit here. It's interesting to see Swiss Noki potentially breaking much lower as well. And then I wanted to do a very brief look at a Euro Sterling chart as we look at the Brexit summit today. Really stuck in this range. The word is that the EU is going to reject Theresa May's short delay scenario and head for a delay possibly to the end of the year, or even a full year into March 29th, the one-year anniversary of the original Article 50 deadline. I do not think this is necessarily good news at all for sterling, because it doesn't clear anything up, and we have the lack of interest in investment in the UK dragging on until we see what Brexit actually looks like. I suspect we have to head towards a second referendum if we're going to see a longer delay. So we'll keep an eye on that. Look at the calendar today. We have a lot on the agenda. The Brexit summit, as mentioned, I think we see what a delay taking shape there, so there may not necessarily be room for massive volatility, but of course we need to stay on our toes. A couple of other UK data points. The ECB announcement, we already covered that, and what Draghi is, his stance at the presser, very interesting. I think the US CPI has far more impact, potentially, if there is a surprise, than the actual FOMC minutes, which are later in the day. Do note that UK RICS house price balance, this is one of the better leading indicators on the UK housing market. It registered, I believe it was minus 28%, very low levels, the worst since sort of the post-financial crisis environment, as we're seeing the real estate sector potentially pressuring UK consumer confidence as well in the UK, as if Brexit wasn't bad enough. That is it for today. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.